Let's ask ourselves this. What if every single country in the entire world is actually in debt? How can that be possible? If everyone owes money, who's the money owed to? So let's take a look at how our world came to owe so much money and who it's all owed to. Welcome to the channel. A few weeks ago, we did a video about US national debt and how it's basically impossible for any person to really understand just how much money we're talking about. The US government has recently started borrowing over $6 billion per day just to keep up with its daily operations. Everything from national defense to funding scientific research to paying the salaries of teachers or the post office workers who deliver your mail. And all that adds up to roughly $31 trillion of debt. But as we learned while researching that video, the US isn't the only country in the world running a deficit. In fact, almost every single country on Earth owes more money than it has available. But there are two problems with that statement. One, we still have yet to find a country that isn't in debt. And two, while technically it is possible for an individual country to get out of debt, the whole world getting out of debt seems like a much harder task, especially when even our best efforts to do so seem to fail. To really understand what's going on here, we need to first talk about something called the circular flow model. This diagram here is the basis of most modern economies. On one side, you have households who own the factors of production, things like factories, farms, stores, schools, offices, things like that. These households then sell these factors of production to businesses who then use them to produce goods and services that they sell to the consumers, which are the people. The people then use that money they earned from selling their stuff to pay the rent or buy a home from the landlords, pay for electricity from the power companies, buy food from grocery stores or clothes from H&M. Businesses also pay taxes to the government who uses that money to fund all the things we talked about earlier. National defense, scientific research, parks, hospitals, teacher salaries, etc. Now, if we ignore international trade for a second, this is pretty much how our economy works. But we know it doesn't work exactly like this because no one pays cash for anything. Instead, we use credit cards and bank loans. So instead of people buying a TV from Best Buy by handing over $849 in cash, we finance it by taking out a loan from our bank who gives us the money under the promise that we'll pay them back with interest over the next 24 months. For the sake of keeping this simple, let's say that TV costs $850. First, we take out a $20 loan from the bank to cover the extra cost, and we promise to pay back the $20 plus $1 in interest. We hand over $850 to Best Buy, who then gives us the TV. Later, we get the job, earn the money we needed to repay the loan, and more importantly, we paid back the bank with that $1 in interest. When we include interest payments into the equation, the price of that TV goes up from $850 to $851. That $1 comes from the money we're borrowing, and it acts like a fee for borrowing that money. Now, where does that $1 go? Well, it goes to the bank who lent us the money in the first place. And that's essentially how all spending in our economy works. When we borrow money, the price of whatever we're buying increases by the amount of money we're borrowing times the interest rate that we're paying on that loan. Now, since this is the method by which all spending occurs in our economy, it should come as no surprise that the more money is borrowed, the higher prices get. Since the global financial crisis of 2008, banks around the world have been incredibly careful about who they lend money to and under what terms. They've made it much harder for regular people to take out mortgages, and credit card companies have put much tighter limits on credit cards. Even governments have struggled to borrow large amounts of money in recent years. So while it used to be the case that when the US government wanted to borrow money, they could just sell treasury bonds to investors at near zero interest rates. Now, they have to offer investors a very attractive interest rate just to convince them to buy their bonds. A big part of the reason for this is inflation. Inflation is simply the rate at which prices increase over time, and the higher the inflation rate, the faster prices rise. Right now, the inflation rate in the United States is about 3%, meaning that a good that costs $100 today will cost $103 in 2 years. And this brings us to the interesting part. Investors want a return on their investment. Let's say you have $1,000 and you invested in a bond with the expectation that you'll receive a 5% annual return. For investors, this means that they do not trust that the value of their investment will continue to grow faster than the rate of inflation. Therefore, they demand a higher return, which means that governments, businesses, and people have to borrow more money to cover the increased cost, which leads to even higher interest payments, which leads to even higher prices, which leads to even more money being borrowed, and the cycle continues. So why is all this important? It's important because according to estimates by the World Bank, the total debt held by all people, businesses, and governments in the world is over $281 trillion, which is roughly 365% of the world's total GDP. But here's the problem. Total world debt is increasing at a rate of about $8 trillion per year, but world GDP only grows by about $3 trillion per year. What this means is that the amount of money owed is growing much faster than the amount of money that's available to repay it. The numbers are so staggering that it's really hard to wrap your mind around them. So let's take a step back and see if we can simplify this. The way we got here is by borrowing money to spend more money than we make. The more money we spent, the more money we needed to borrow. The more money we needed to borrow, the more expensive things became. The more expensive things became, the more money we needed to borrow just to maintain our standard of living. And now we're in a situation where the amount of money we owe is growing much faster than the amount of money we have available to pay it off. Who owns all this money? It's actually impossible to say. Most of it is owned by other people, businesses, governments, and countries just like us who are in debt themselves. And it's not like we can stop borrowing money either. If we did, the price of everything would immediately drop, causing chaos in our economy. Even worse, we can't all just agree to stop owing each other money, because that would mean that governments would stop taxing us, businesses would stop paying their investors, and we'd stop paying our loans to the banks, none of which are things that anyone wants to happen. So in a world where everyone owes money and no one can pay it off, what happens? Well, the answer depends on who you ask. Some people argue that it doesn't matter if we never pay off our debt because the money is owed to people in other countries and therefore it's all just canceled out. Others argue that it does matter because if we're unable to pay off our debts, investors won't lend us money in the future, driving up our interest rates. Still others argue that it's not a problem because money is digital and therefore there's no limit to how much money we can create. Personally, we tend to agree with the first argument. The world is a giant web of interconnected people, businesses, and countries who all owe each other money. We do our best to pay each other back, but sometimes we're unable to do so. Sometimes countries even default on their debt, refusing to pay back the money they owe. While this can cause some short-term pain, ultimately it doesn't really matter because the money is owed to someone else who owes money to someone else who owes money to someone else, and so on and so forth. So the answer to our question is that it doesn't really matter who owns the debt because it's all just canceled out. No one pays off their debt. Instead, they refinance it and issue new debt to replace the old debt until eventually it all goes away. But what about the interest we pay on our debt? Interest is simply a transfer of money from people who have extra money to people who need it. The banks, investors, and governments who lend money to us only charge us interest because they can. They don't have to lend us their money. They could just as easily save it or spend it on something else. Interest is just an added bonus for them, and it's a necessary evil for us. So while the numbers are staggering and seemingly impossible to comprehend, the truth is that they don't really mean anything because they're all just canceled out. Everyone owes money to someone else, and everyone who lends money does so willingly. So the real answer to our question is that it doesn't really matter who owns the debt because the whole system is built on the idea that we never pay it off. Hopefully this cleared up any confusion you might have had about how debt and money work. If it did, please consider subscribing. As always, thanks for watching.